Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the best stocks to buy right now that are blue chip, safe, stable, and undervalued. If you're the type of investor who believes the stock market is going to crash or we are going to enter into a more negative economic recession, then this is the video for you. We will be analyzing 7 blue chip stocks that are trading at a phenomenal valuation so we can buy them up right now. I will be disclosing if I own these companies, if I think there is another company in their same space that is better, and whether or not I will continuously buy these companies. We're going to start off with the ticker symbol QSR, and this is Restaurant Brands. And if you don't know, this business is the owner of Burger King as well as Popeye's Chicken. And they recently brought in Patrick Doyle as their executive chairman last year. And Doyle is a very prominent executive because he helped Domino's Pizza, ticker symbol DBZ, attain amazing results during his 8 years as their CEO. And if you look at Domino's overall growth rate over the last 5 years, you know that this person has done a phenomenal job. So it's great news that he has joined Restaurant Brands. Wall Street professionals and experts even turned up the heat for this company because they have increased their ratings for ticker symbol QSR. They have increased their market perform rating up to an outperform rating, and other professionals upgraded the stock from sector weight to overweight, meaning that this company is a phenomenal buying opportunity. Currently, the share price trades for $65, and they also offer investors a very healthy dividend coming in at 3.28%. The risk to reward ratio for this company is very compelling, considering that they have a price target and price prediction that comes in at $76. So for a blue chip company, this company has a phenomenal upside potential. It's resilient, it's not at risk of going out of business, and even during a stock market crash or recession, this company is going to give you gains. I also want to point out that they have a forward price to earnings ratio of just 16, which is much better than their largest competitor and rival, which would be McDonald's, ticker symbol MCD, which I also own because they are a phenomenal company, but they have a PE ratio of 27, making this company a better buying opportunity, at least right now. However, I personally own both of these companies, so at minimum, put this company on a watch list, and at maximum, do your own research and think about adding it to your personal portfolio, even if you think the stock market is going to crash in 2023 or 2024. Moving right along, we have another company that I also own named Micron, ticker symbol MU, and if you see this check mark over here to the left, it means I personally own this company. Micron is a computer flash memory maker, and they have recently surged in their share price based off of news that Samsung has cut its overall production of memory chips by a meaningful level. This is why Citigroup recently responded with a note saying that the production cut by Samsung would ignite a recovery in Micron's overall dynamic random access memory, also known as their DRAM or DRAM technology. The best news is that Samsung's products currently accounted for 50% of all DRAM chips, and Citi is now predicting that this particular sector will rebound quite nicely due to their heavy reliance on DRAM chips. And because Samsung has cut their production, they are going to have to rely on other companies to fill that void, which of course would be Micron. This means that Micron is going to increase in their overall demand for their DRAM technology, and they also are seeing a rise in demand for DRAM chips in regards to smartphones and PCs. Overall, ticker symbol MU is very bullish, and they have a very long-term growth trajectory. Right now, the MU share price trades at $60 per share, but professionals believe the company could surge up to $70 while offering a 0.7% dividend yield. Although this doesn't seem like a lot of upside, imagine if the stock market crashes, but you could still make money from this particular stock because they are so stable and resilient, especially as this new demand has flooded into the overall market. So that's the perspective we are taking. Even if the overall economy is going downwards and we enter into a recession or stock market crash, we are still going to be able to make money with these types of investments. Up next, we have AGCO, ticker symbol AGCO, and this has a X next to it, meaning that I do not own this company in my personal portfolio, and I'll tell you why. However, it may be good for your portfolio if you do more research, so let's talk about the company. This is a maker of farm equipment and other products that are used by farmers, and right now they are currently very well positioned to continue overall record-breaking results. For instance, since food prices are increasing, this has resulted in an elevated income for farmers in some instances. Therefore, AGCO's top-of-the-line growth regarding their financials have soared by 24%. For instance, let's look at their earnings per share. Their earnings per share surged from $3.08 all the way up to $4.47 due to this new development in the market. The CEO even expects the sales to continuously grow and increase as they focus on expanding their overall margin as the industry demand remains strong. Therefore, this company is very attractive, and they also have a very compelling forward price to earnings ratio of just 8.8. Right now, the company trades for $124 per share, but experts believe the company could surge up to $144 over the next 12 months, while also offering investors a 0.78% dividend. Now, the reason I don't own this company is because I would rather own other companies like Deere, and I think they are actually a better investment opportunity. Even though we are seeing strong demand for this particular company, I just don't own it in my portfolio. But if you want to look further into this company, then feel free to do so, because after all, this is a very stable blue chip stock. Next, we have another company which has an X next to it, which means I don't own it in my portfolio, but again, it may be good for you, so I want to at least make you aware of it, especially if you are a dividend investor. The company's ticker symbol is GBX, and they are a rail car maker. The company's revenue recently jumped from $766.5 million to $1.1 billion. The company also saw an increase in their overall EBITDA from $48.7 million to $98 million, so it has literally more than doubled. On top of that, they saw their adjusted earnings per share, get a load of this, jump from 5 cents to 99 cents, on top of a very strong and impressive backlog worth $3.1 billion worth of work that they haven't even gotten to yet. Right now, this company is trading at $32 per share, but investors believe this company should be trading closer to $47, while also offering a very strong dividend yield of 3.26%. So if you are a dividend investor and you want some exposure to a very fundamentally solid company, despite the potential of a stock market crash in 2023, then this could be the company for you. However, I am not a dividend investor, I am a hybrid investor, and this particular company doesn't meet the criteria that I look for. But what about our next stock on the list? That would be NXP Semiconductors, ticker symbol NXPI, and this has a hold rating next to it. So it means that, yes, I own a little bit of this company, but I own one of their competitors even more, which would be Taiwan Semiconductor and other semiconductor companies like that, or at minimum, buy an ETF that has some of the best semiconductor stocks already in it. But for this particular company, let's go over what they do. Clearly, they are a semiconductor company that is well positioned to continuously increase their overall production of chips for automakers, industrial companies, as well as firms that make products connected to the internet. Meanwhile, NXPI also sells chips for PCs and handsets. Therefore, Citigroup has predicted a very long growth runway for this overall company. They have also increased their overall revenues very aggressively, and they are currently trading at a forward earnings ratio of 13.6. Right now, the company trades at $170 per share, and if that's too much for you, don't worry, you don't have to buy this stock in full. If you have an investment platform that allows you to invest into fractional shares or share slices, you could invest into this company for as little as $1. With that being said, many prominent professionals believe this company should be worth at maximum $240 over the next year, and they also offer a very strong dividend of 2.06%. But in the end, I do think that there are other companies which offer an even better upside potential, but nonetheless, this company is still a solid blue chip company. Next up, we have Wells Fargo, and again, I have a hold rating for this company because I do believe there are other competitors who are in a better position than Wells Fargo. Wells Fargo is a bank that essentially is quote-unquote too big to fail, ticker symbol WFC, but I think there are other banks, or at least financial institutions, which are better positioned, such as JP Morgan Chase, Charles Schwab, Bank of America, even Ally Bank I would put on this list. But Wells Fargo is still a solid blue chip company, so let's see what this author has to say about it. Wells Fargo should benefit from deposit inflows from consumers who originally wanted to bank with a smaller bank, but amid current fears of financial institutions potentially going out of business, this is going to cause an inflow from consumers who are going to take their money out of smaller institutions and put them into larger banks who are quote unquote too big to fail. The company currently trades for $39, but many experts believe this company is undervalued right now because it should be trading at around $58, and they do offer a pretty good dividend of 2.92%. The investment bank named Raymond James recently raised their rating for Wells Fargo from outperform to strong buy. So I'll let you be the deciding factor on whether or not Wells Fargo is a good company to invest into right now. However, I have a hold rating on this company because I do believe there are other better financial institutions to invest into, at least right now. Lastly, we have Stellantis, and this has a giant check mark from me because I do own this company. Stellantis is a European-based auto company which owns Chrysler and Fiat, and they have recently delivered very strong results due to their electrification of their popular Ram brand and their Jeeps. Stellantis, ticker symbol STLA, trades for just $18, but experts, professionals, and analysts alike believe this company is very undervalued to where it could more than double in their overall share price. On top of this doubling, they also offer a very strong dividend yield of 6.61%, and this is why I own this company. Since I take a hybrid approach of identifying companies who have both long-term growth and strong dividends, this company is on my list because they could double in their share price, or rather more than double, and they also give a very strong dividend yield. I also want to make investors aware that the company's net profit jumped by 26% recently, and they reported that they were the #1 in selling electric vehicles to companies in the European Union, and the #2 company in overall sales in the same segment. Now, will they be able to keep this momentum up? Who's to say? I don't know. The competition is absolutely fierce in the EV and automotive space. However, even with that being said, this is a very solid blue chip company that gives a phenomenal dividend and has great growth ahead of it, paired with a very impressive accounting ratio because they're trading at a very cheap valuation, considering that their forward price to earnings ratio is just 3.6, and ideally we would want that as low as possible, and it is literally the lowest on this entire list, while also giving us the most upside and the largest dividend, which is why this company has a big old check from me and I own it in my personal portfolio. So as always, if you stayed to the end of this video to hear me analyze Stellantis, then thank you. Feel free to put this company on a watch list. Always make sure to do your own research. Smash that like button for more videos just like this one. Subscribe if you are new, and I will see you in the next YT video.